Hi, everybody. This is Ellman, the Blue Collar Investor, and welcome to our BCI podcast number 9, this one titled Timing the Two Legs of Our Covered Call Trades. It's also going to be a discussion of exit strategies. Now, those of you familiar with covered call writing know that there are two components to the trade. We're long the stock and we're short the option. So we must master the 3 required skills before we get into a covered call trade. What stock are we going to select? And in this case of timing, when do we select it? What option are we going to select? How long out are we going to go on our expiration date? Are we going to go in the money, at the money, or out of the money? And once we determine that, when do we sell our option? Finally, when do we prepare for our exit strategy execution opportunities? So we must master the 3 required skills and then decide when to enter these trades. Now, one of the important factors that we must understand is the effect of theta, or time value erosion, on our covered call trades. Now, theta is one of the option Greeks that determine the factors that influence the price of our options and also let us know about the risk of our options. So for every calendar day that passes, the time value component of our options will deteriorate. A good analogy would be we go out and buy a car. As soon as we pull out of the dealer's parking lot, the value of that car starts declining. 6 months later, it's worth even less. A year later, even less. Same thing with our option premiums. The time value component will deteriorate every calendar day. But it won't deteriorate in a linear fashion, not in a straight line, but rather logarithmically. What I mean by that is the deterioration of time value starts out very slowly, and then it goes very quickly as we approach expiration Friday. For those of you looking at the screenshots I provided, the yellow field shows how slow the option time value deteriorates initially, and then it kind of falls off a cliff as we're approaching expiration Friday. So what does that tell us? Well, if we're in the business of generating cash flow by selling options, we want to sell our options as early in the contract as possible. Because if we wait longer into the contract, we're going to be receiving less time value premium. All right, and that goes totally against our objectives of generating as much time value profit as possible. Now, let me give you an example. Buffalo Wild Wings, when I made this slide and when I made this look up at our option chain, the BWLD was trading at 82.40. Now, in a bear market environment, we're going to favor in-the-money strikes because they have an intrinsic value component that gives us further downside protection. So I looked at the 80 strike in the money, lower than current market value, and that generated a bid price of $4.40. Well, since BWLD was trading at 82.40 and was selling the 80 strike, that's $2.40 in the money. We're going to lose $2.40 on the sale of the stock, so we deduct that from the $4.40 premium, and that came out to an initial time value return of 2.5%. Now, if the share price goes up, we cannot participate in any share appreciation because we are obligated to sell at 80. Now, we have downside protection of 2.9%. What that means is we are guaranteed a 1-month profit of 2.5% as long as share value does not decline by more than 2.9%, or as long as it doesn't go under the $80 strike price. So that was the initial calculations if we entered this 1-month trade early in the contract. And we have to make sure that our covered call trades meet our initial time value return goal range. In my case, it's 2 to 4%. In bull markets, I'll go as high as 6%, but never more, because the higher the returns, the riskier the trade. In this case, 2.5 would beat my 2 to 4% goal range. Now, if we wait too long, theta is going to erode the time value that we're going to be able to generate. So that's a reason why we want to sell our options early in the contract. And if we're buying a stock early in the contract, we want to immediately sell our option. This way, we know what we're going to get as our return goal, and if the deal is there, we take it. Also, it'll create some exit strategy opportunities for us. If we wait too long before we sell the option, we may miss out on those opportunities. As an example, we're going to go back in time to August of 2018, when a BCI member told me about 3 stocks that she purchased early in the August contracts. They were Health Equity Inc., ticker HQY, Copart Inc., ticker CPRT, and HD Supply Holdings, ticker HDS. She bought these stocks and felt that she's going to wait for share appreciation and then sell the options to make even more money on the share appreciation and be able to sell a higher strike. The point in time when the trade was entered, all 3 of these had a very nice uptrend when you look at the price chart. So for those of you actually viewing these price charts, to those not, I'll describe them. You could see that on the right side of the chart, it was an uptrending stock when all of a sudden, as soon as she bought them, boom, the price declined. And it wasn't a matter of an individual company problem. The entire market declined at that point in time. So for a brief period of time, the market declined. Now remember, she hadn't sold the option yet. So now she's in a position where if she sold an option, to make a good premium, she'd have to sell at a lower strike price. Now, what happens about a week later? The price recovered, as did the entire market. The amazing thing is all 3 of these chart patterns look exactly the same. Now, if you were to envision any stock that was uptrending and all of a sudden declined in price and then quickly recovered, you would probably visualize a classic V-shaped pattern. Now, had the call option been sold initially when the shares were purchased, and then we entered our 20%, 10% guidelines, where we buy back the option when the price declines as a result of share price depreciation, we could have bought back that option at the bottom point of that V-shaped pattern, and then as it recovered, sold the same exact option. In my books and DVD programs, I refer to this as hitting a double. 2 income streams in the same month with the same cash, with the same stock. We couldn't do it if we waited to sell that option, which is what was done in this case by our BCI member. So not only are you losing out as a result of Theta, but you're missing out also on exit strategy opportunities. So let me summarize how this works. Both legs of the trade should be executed early in the contract. Remember, Theta will reduce our time value for every calendar day that passes. Stock selection should meet our system criteria. In the BCI methodology, we use 3 prongs of stock selection. We use fundamental analysis, technical analysis, and common sense principles like minimum trading volume. And the screening process will then generate a watch list of elite performing stocks. Option selection. What expiration dates? I prefer 1-month options. What about the moneyness of an option? Out of the money is more bullish, and in the money is more defensive. So depending on the overall market, depending on the chart technicals, you can make your selection from there, making sure that the strike price will generate your initial time value return goal range. As I said, mine is 2 to 4%, up to 6% in a bull market environment. Once we enter the trade, immediately, we move into position management mode. When we enter, we can immediately enter buy to close limit orders based on our 20%, 10% guidelines. And I detail how this works in all of my books and DVD programs. So when do we start position management mode? Immediately, once the trade is entered. And we can automate it to a great extent using the 20%, 10% buy to close limit orders. Now, Theta considerations are critical to when we enter our trade and how we manage our positions. So you have to understand Theta. You don't have to look up the actual Theta statistics, but just picturing the logarithmic nature of time value erosion due to theta is something very helpful to us in timing our trades. Now, I brought up the Ellman calculator before, where we get the return on our option, upside potential, downside protection. I know most of you listening to this podcast already have a copy of the Ellman calculator, but for those who don't, just go to our website, www.thebluecollarinvestor.com. Look at the black bar at the top of all of our web pages. Just click on the link that says free resources, including the Ellman calculator. Put in your email address and you can download the calculator and its user guide right to your computer or whatever device you prefer. Now, for those of you who want to take this information to an even higher level, related to trade execution and exit strategies, we have a series of educational products available in the BCI store. The complete encyclopedia for covered call writing, best-selling book on covered call writing, along with volume 2. You should read the classic edition first. We also have a volume 2. And we have a DVD program that was recently updated, which involves 4 video lessons, along with a workbook that can be downloaded. So this is an online streaming DVD program with a downloadable workbook. So just go to the Blue Collar store and you can get these educational products that will go through the entire process. So I want to take the time to thank you for watching this podcast. I create these podcasts based on your feedback to me. I always want to know, what are our members thinking? What are they interested in? What kind of information will be best suited to enhance their portfolio returns? So thanks very much for your feedback and for taking the time to watch this podcast. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.